Hello everyone and welcome to the webinar. Thank you so much for joining us. This session is titled Negotiate the Numbers. My name is Chelsea Thornton. I'm a training coordinator for Plaza Home Mortgage. The information being presented is provided by Arch Mortgage Insurance. Our presenter today is Diana Swift, National Trainer and Instructional Designer. Diana has more than 25 years experience in the mortgage industry, including roles in underwriting and operations. And with that, I'll hand things over to you, Diana.
Easy for you to say, Chelsea. Okay, thanks, Chelsea. Well, hello, everyone. Happy Monday, I guess. If you're like I am, that weekend just flies by, and here we are on a Monday again. But anyway, glad you're here, and thank you for allowing us to come in and do this presentation. Today we're going to talk about, we call it Negotiate the Numbers, and it's the basics of business tax returns and self-employed borrowers. So hopefully everyone has a handout so you can make your notes if you want. Just have to have this for our legal department. Okay, here's our objectives, and these are what we're going to talk about. So after attending the session, you'll understand self-employed borrowers and the different business structures. You'll understand cash flow adjustments, including allowable add-backs and required deductions. You'll know when a profit and loss statement is needed. You'll understand net operating losses, and you'll know when personal debt paid by the borrower's business can be excluded from the debt ratio. So you can see we have a lot of information to go over today. But as always, let's begin with the fundamentals. So who's self-employed? When should the box be checked in the employment section of the application? And most of you already know this, but according to industry standards as set by Fannie Mae and Freddie Mac, any individual who has a 25% or greater ownership interest in a business is considered to be self-employed, and you'll need to get tax returns. So why are self-employed borrowers unique? What makes them so special? Well, income for self-employed borrowers can be variable and unpredictable, and on top of that, income and employment can sometimes be difficult to verify. Now, according to Fannie Mae, there are certain factors that must be analyzed before approving a mortgage for a self-employed borrower. These are the stability of the borrower's income, the location and nature of the borrower's business, the demand for the product or service offered by the business, the financial strength of the business, and the ability of the business to continue generating and distributing sufficient income to enable the borrower to make the payments on the requested mortgage. So why do we need tax returns in the first place? Well, 2 years of personal and business tax returns are required for income and employment verification when your borrower is self-employed. Tax returns are considered an independent third-party verification. Now, typically, the income on a tax return is uninflated. That's because the taxpayers want to keep as much of their money as possible and give as little of it to the IRS as legally permissible. And most of the time when they're filing taxes, they aren't doing so with a future application in mind, or they don't understand that there's a difference there with how we look at their tax returns for a mortgage. And of course, if you're ever in doubt regarding the authenticity of the tax return, you can request a transcript, which I think most of you do anyway. So self-employed income calculation is always based on historical average in order to see the entire picture, which includes the health of the business. And that's where the tax returns come into play. Now, making sure that you have complete tax returns with all schedules is crucial when tax returns are part of your income verification documentation. But keep in mind, there are scenarios where business tax returns can be waived as a documentation requirement, but personal tax returns are always required. But having said that, it's important that you refer to your AUS or Automated Underwriting System findings and your investor requirements. Okay, so before we discuss how income is evaluated, let's take a look at the various business structures. And there are 5 basic business structures, including sole proprietorship, partnership, limited liability companies, S corporations, and corporations. Now, the legal structure of a business determines the way business income or loss is reported to the IRS, the taxes that are paid, the ability of the business to accumulate capital, and the extent of the owner's liability. So let's look at each one of these based on Fannie Mae's definition. Okay, a sole proprietorship is an unincorporated business that is individually owned and managed, and the individual owner has unlimited personal liability for all debts of the business. If the business fails, the borrower not only will have to replace his or her lost income, but also will be expected to satisfy the outstanding obligations of the business. Now, since no distinction is made between the owner's personal assets and the assets used in the business, creditors may take either or both to satisfy the borrower's business obligation. So sole proprietor, again, is individually owned. It's someone who is 100% owner of the business. Now, the financial success or failure of this type of business depends solely on the owner's ability to obtain capital and to manage the various aspects of the business. Poor management skills or an inability to secure capital to keep the business running will compromise the continuance of the borrower's business and their income. The owner's death terminates the business and may cause the assets to fade, thus delaying the disposition of the assets to creditors and the heirs. The income, expenses, and taxable profits of a sole proprietorship are reported on the owner's IRS Form 1040, Schedule C, and are taxed at the tax rates that apply to the individuals. Okay, a partnership is an arrangement between two or more individuals who have pooled their assets and skills to form a business. These individuals share profits and losses according to predetermined proportions that are set out in the partnership agreement. Now, partnership may be either a general partnership or a limited partnership. In a general partnership, each partner has unlimited liability for all debts and obligations of the partnership. A limited partnership consists of one or more general partners and one or more limited partners. Limited partners have limited liability. Their liability is limited to the amount of their investment. Now, the partnership must report its profit or loss on IRS Form 1065 and each partner's share of the income or loss on IRS Form 1065, Schedule K1. However, the partnership pays no tax on the partnership income. Each partner uses the information from the IRS Form 1065, Schedule K1 to report his or her share of the partnership's net profit or loss and special deductions and credits on his or her IRS Form 1040, whether or not the partner receives a cash distribution from the partnership. Individual partners pay taxes on their proportionate share of the net partnership income at their individual tax rates. A limited liability company, or it's called an LLC, is a hybrid business structure. It's designed to offer its member owners the pass-through tax efficiencies of a partnership or sole proprietorship and the limited liability advantages of a corporation. The member owners of the LLC or their assigned managers can sign contracts, sell assets, and make other important business decisions. The LLC operating agreement may set out specific divisions of power among the member owners or managers. Now, although the member owners generally have limited liability, there may be some instances in which they are required to personally guarantee some of the loans that the LLC obtains. and profits from the operation of the LLC may be distributed beyond the pool of member owners, such as by offering profit distributions to managers. Now, the LLC may report its profit or loss on the IRS Form 1065 or 1120-S, which is sole proprietor, if it has more than one owner. Each member owner's share of the profit or loss is reported on a Schedule K-1 of these forms. However, the LLC pays no tax on its income. Each member owner uses the information from Schedule K-1 to report his or her share of the LLC's net profit or loss and special deductions and credits on his or her individual IRS Form 1040, whether or not the member owner receives a cash distribution from the LLC. Individual member owners pay taxes on their proportionate share of the LLC's net income at their individual tax rates. If the LLC has a single owner, it will file a Schedule C. There will be no separate business return or K-1. One of the most important things to remember, I think, about the LLC is there's not a separate business form for the LLC. They can have an LLC and file it on a partnership. They can have an LLC and file it on a sole proprietor. And they can have an LLC and file it on a corporation or on an S corporation. Okay, an S corporation is a legal entity that has a limited number of stockholders and elects not to be taxed as a regular corporation. Business gains and losses are passed on to the stockholders. An S corporation has many of the characteristics of a partnership, and stockholders are taxed at their individual tax rates for their proportionate share of ordinary income, capital gains, and other taxable items. Now, the ordinary income for an S corporation is reported on IRS Form 1120-S, with each shareholder's share of the income reported on the IRS Form 1120-S Schedule K-1. Now, because this income from the distribution of corporate earnings may or may not be distributed to the individual shareholders, the lender must determine if the borrower received a cash distribution from the S corporation. Okay, a corporation is a state-chartered legal entity that exists separately and distinctly from its owners, who are called stockholders or shareholders. It's the most flexible form of business organization for purposes of obtaining capital. A corporation can sue, be sued, hold, convey, or receive property, and enter into contracts under its own name, and it does not dissolve when its ownership changes. Now, there are two types of corporations: publicly owned, which are widely held corporations, and privately owned, which are closely held corporations. Now, because more than 50% of the outstanding stock of a privately owned corporation is owned directly or indirectly by no more than 5 people, the corporation has legal or no access to public funds, and it must raise capital through institutional financing. Now, although legal control of the corporation rests with its stockholders, they typically are not responsible for the day-to-day operations of the business, since they elect a board of directors to manage the corporation and delegate responsibility for the day-to-day operations to the directors and officers of the company. The distributions of profits earned by the business is determined by the corporation's board of directors or other entities that have a significant financial interest in the business. However, the profits usually are filtered down to the owners in the form of dividends. Since a stockholder is not personally liable for the debts of the corporation, losses are limited to his or her individual investment in the corporation's stock. Now, corporations must report income and losses on IRS Form 1120, and they pay taxes on the net income. The corporation distributes profits to its shareholders in the form of dividends, which it reports on IRS Form 1099. The shareholders must then report the dividends as income on their individual IRS Form 1040. Okay, a compensation of officers form, Form 1125E, can typically be used to determine a borrower's share of ownership. Now, with a partnership and an S corporation, they have a K1. A corporation does not have a K1, but they have the 1125E. So you would just simply add the percentages of common and preferred stock on the road that includes his or her name. Now, note that the compensation of officers is only completed if total corporate receipts are $500,000 or more. If the form is not filed, you're going to have to document your borrower's ownership percentage via other means, such as the Articles of Incorporation or the state database of registered businesses. So in other words, you still have to determine their percent of ownership, but if their assets are less than, total receipts are $500,000 or more, then the form is not filed. So you just follow the instructions here. Okay, as we go through, we have knowledge check questions, which I believe Chelsea has set up as a poll question. So here's our first one. Do you think this is true or false? The Limited Liability Company, LLC, has its own separate IRS business tax return form.
All right, we had 63% who said false.
All right, well, let's see if 63% are correct, and they are. The LLC does not have a separate IRS tax return form. Okay, so now that you have a basic understanding of the various business structures, let's move on. And one of the most important things to understand when discussing self-employed borrowers and determining qualifying income is cash flow adjustments. Now, cash flow adjustments are both positive and negative changes that an underwriter makes to a borrower's taxable income for mortgage qualifying purposes. So why do we make cash flow adjustments? Well, taxpayers make qualified and allowable adjustments on their tax returns to reduce the amount of their taxable income. Additionally, there are some expenses that they incurred for which only portions can be deducted. Now, our responsibility when qualifying a borrower for a mortgage is to figure out to the best of our ability how much they actually made, not to simply review how much of their income is taxable. So therefore, we make adjustments when prudent. Now, regardless of the type of business, there are some basic principles that apply across the board when it comes to making cash flow adjustments. Expenses that we review for add-back consideration fall into two buckets. An expense that a taxpayer deducts for his or her taxable income is either a cash expense or a non-cash expense. Some cash expenses can be added back. All non-cash expenses can be added back, and that's very important to remember that. Okay, so let's begin by discussing non-cash expenses because they're the most cut and dry. And there are three types of non-cash expenses. They are depreciation, depletion, and amortization. And again, typically, all non-cash expenses can be added back. However, it's important to note some investors have overlays that do not allow amortization, and that's why we have that asterisk on the amortization there. Now, depreciation is associated with fixed assets, tangible property. Things like buildings, machinery, vehicles, furniture, and equipment are all depreciable. And depreciation is an annual allowance for the wear and tear, deterioration, or obsolescence of the asset. Fixed assets lose value, and it is that loss of value that is being written off in the form of depreciation. Now, depletion is the using up of natural resources by mining, drilling, cutting timber, and the depletion deduction allows an owner or operator to account for the reduction of a product's reserves. Now, because it's associated with non-renewable natural resources, depletion is a business deduction that you'll seldom see. However, if a depletion deduction was taken, you can add it back into the cash flow. So it's very common to see depreciation, but not as common to see depletion. But if they write off depletion, you can add it back in. Okay, then the final cash expense is amortization. And amortization is associated with intangible items such as goodwill, trademarks, patents, and logos. It's a way of accounting for the cost of an item over a period of time. So, for example, an amount might be spent in 1 year, which would be an actual cash amount, but written off over a period of time in subsequent years, could be up to 15 years even. But once it is amortized, it's no longer a cash expense because it is not a cash expense in that tax year. But remember that while Fannie Mae and Freddie Mac always allow amortization to be added back, there are some investors who do not allow this add back. So be sure to check for your overlays and your investor requirements. Okay, so let's move on to cash expenses. Everything that is not a non-cash expense is a cash expense. But remember, not all cash expenses can be added back. So let's talk about the cash expenses that can be added back. And we've got 3 categories here as well. Casualty losses, expenses for business use of home, and some other expenses that may be added back as well if they meet certain criteria. Now, it's important to note that in order to add back most cash expenses, you must typically, that slide, I hope your slide doesn't look like mine. Looks like that important got a little crazy on us there. Hopefully yours looks better than mine does, but you know what we're saying. So it's important to note that in order to add back most cash expenses, you must typically have 2 years of tax returns, even if your findings or feedback only require 1. Adding back cash expenses to the qualifying income is often considered a last resort because of the support documentation required. Okay, so let's talk about casualty losses. Casualty losses are due to things like theft, fire, or flood. These are the expenses that are incurred directly by the business. So in other words, expenses that the insurance did not cover. Now, these expenses can typically be added back because they are usually considered extraordinary and non-recurring. But you want to be sure to look for a lack of a pattern from 1 year to the next before adding them back. And also note that they won't always be labeled as casualty losses on the tax return. These itemized expenses will often be categorized as the expense that they actually are, such as loss due to flood damage. And again, it's important that you determine that these expenses are extraordinary before you add them back into the qualifying income. So if they're labeled as casualty losses, make sure to document what the losses are actually for. So, don't go there if you don't have to. If they have cash expenses, if casualty losses, and you qualify them without adding those back in, then take it and run with it. But if you do need to add these back in, you have to do your due diligence. Okay, business use of home. Expenses for business use of home can be added back. When someone has an office in their home that they devote entirely to business use, they can write off a percentage of their household expenses, and it's typically based on the square footage of the office. Now, the reason that we can add these back is that these expenses would be incurred anyway, even if they didn't have an office in their home. And also, it's becoming more common for people to work remote, for people to work from home. And these expenses can be found on line 30 of the Schedule C. And you can see that our borrower has $1,123 of business use of home expenses, which, as we discussed, can be added back. The business use of home expenses are the exception to the cash expense rule because there's no need to document that they are non-recurring. So in other words, if they write off expenses for business use of home on line 30 of Schedule C, you can add those back in. Okay, and then finally, let's take a look at those other cash expenses. Now, since we can identify specific expenses that can be added back, this bucket is for non-specific expenses that the business may incur. Now, every business is different, so every business has different kinds of expenses. When additional expenses are itemized, there are typically 3 questions or burdens of proof that you'll want to pass before adding back any additional cash expenses into the qualifying income. But you want to be very cautious here. First, make sure the dollar amount is significant enough to make a difference in the loan. If it's a small dollar amount that won't affect your borrower's ability to qualify, then you don't even have to bother with it. But if the dollar amount is significant, then you want to determine that the expense is one-time or extraordinary, and it must be unlikely to recur within the next 3 years to meet this burden. If the amount is significant and non-recurring, make sure that the expense is not a regular cost of doing business. And again, the expense must be considered unusual or extraordinary and not a function of the business or expense for an item that the business needs to operate. Now, obviously, these burdens are not all black and white, so you must be able to back up your decision to add back any other cash expenses. You have to be able to justify and back up your decision. A good rule of thumb is when in doubt, just leave it out. Don't even go there if you don't have to. Okay, on the Schedule C, remember this is sole proprietorship, you'll need to review Part 5 on page 2 to see what the itemized deductions are. As you can see, there's no amortization listed here and nothing that could be considered a casualty loss. So what about the other expenses? Well, do you remember the questions you need to consider? For supplies of $1,123 and mail cost of $623, you want to determine if these can be added back. Your conclusion should be that they cannot be added back because they are likely recurring expenses that are a part of the regular cost of doing business. Okay, so here's another example, this time on Form 1120S, which is for an S corporation. When you review line 19, you'll notice a significant amount here, $849,435. Well, I would jump at the chance to add that back in and use that income. However, before you add it back, you need to look at the attached statement in order to make that determination. We get a little too excited sometimes when we see a large amount there. So Statement 1 breaks down the other deductions. We have $120,000 for paper and $729,435 for billboard rental. So what do you think now? Can we add any of this back? Well, remember our questions, and remember that in order to add back cash expenses, you have to have 2 years of documentation. So if we collect and review a second year, you'll see that paper is a recurring expense. You'll also see that advertising is a recurring expense, even though it takes different forms in these 2 years. So another consideration is that advertising is likely considered part of the regular cost of doing business. So these expenses should not be added back to the qualifying income cash flow. Okay, here's our next poll question. Do you think this is true or false? Casualty losses are a cash expense that can be added back as long as you have a 2-year pattern. So see what you think on this one.
It looks like 73% of people who voted said B for false.
All right, well, let's see what the correct answer is, and they are correct. Smart group of people on this webinar. You want to be sure to check for the lack of a pattern from one year to the next before adding them back in. Okay, so let's discuss expenses and income that we must deduct from our cash flow. We've talked about what you can add back in, but let's talk about what you have to deduct from the cash flow. Mortgages, notes, and bonds due and payable in less than 1 year can sometimes adversely impact a business's cash flow. It can also affect the actual working capital needed daily by the business and the capacity for future growth. Therefore, these liabilities should be subtracted from the income. Now, you do not have to deduct mortgages, notes, and bonds due and payable in less than 1 year if it is determined that there are sufficient liquid business assets to cover these obligations, and you would find that on Schedule L, line 1D, which is their balance sheet, or that these obligations roll over from year to year. An example would be lines of credit. Now, if the balance sheet, or that Schedule L, does not indicate sufficient assets to cover the debt, or you cannot show that the obligations roll over from year to year, the liability must be deducted from the qualifying income cash flow. Okay, only half of all meals and entertainment expenses incurred can be deducted for tax purposes. That means that the portion that cannot be deducted, or the exclusion, must be subtracted from the cash flow so that the entire amount of the expense is covered. Okay, so we want to see if there are any meals and entertainment expenses to deduct. So we're looking at Schedule C, sole proprietor, and as you can see, the deductible amount of meals and entertainment expense on line 24B of Schedule C is $49. They actually spent $98, but we subtract that $49, which is half of the $98 that they spent. A lot of people think that they take the $49 and take 50% of that. You don't. That's already calculated for you. You just take the amount that's on line 24B of Schedule C and you subtract that from your income. Okay, on the Corporation Form 1120, on Schedule M1, line 5C, you'll find the amount of any travel and entertainment expenses. And remember, again, this is only 1/2 of what the business spent. So we need to deduct the amount so that the entire expenditure is accounted for. In our example, we're going to subtract $1,745. However, they actually spent $3,490. Okay, you also need to deduct non-recurring income from the cash flow. This includes income from any undetermined sources, which often included income labeled as other income, which is income that the business has earned from something other than its gross receipts. So it stands to reason that any non-recurring income must be subtracted from the cash flow. Now, other income can be found on the Schedule C in the income section on line 6. And remember, other income is often non-recurring income. So unless you can show a history of a specific income source and document that it is likely to recur, it must be deducted from the qualifying cash flow. Okay, so here's an example from a partnership return, which is Form 1065. Now, in this case, we have 4 potential non-recurring income lines to review, lines 4 through 7 of the Form 1065. And these are typically considered non-recurring unless we can document via the attached statement what the source of the other income is, there is a history of this income, and that the source of the income is likely to continue. So in this example, we have a total of 50. Whoops, I was adding an extra 0 in there. So in this example, we have a total of $50,000 that may be non-recurring. So the easiest step for us to take would be to deduct these income sources from our cash flow. But if you can determine that your borrower does not qualify after removing this income, and you can document the source along with history and continuance, you can put the income back in. So again, as with the others, you have to do your due diligence. Okay, here's our third poll question. Think this is true or false? False. All cash expenses can be added back into a borrower's qualifying income.
All right, 91% said B, false.
All right, and they're correct. Remember, we said that all non-cash expenses can be added back, only certain cash expenses can be added back. So good answers, very good. Okay, so let's move on and talk about net operating losses. A net operating loss, or it's sometimes called a loss carry forward, is a loss that was incurred in a prior tax year that is carried forward for tax purposes into subsequent tax years. Now, for tax purposes, this loss can be carried forward for up to 20 years of tax returns or until it is absorbed, whichever comes first. Now, because a loss carryover is a loss that was incurred in a prior tax year and is just simply a write-off against taxable income, it can often be added back. However, again, some due diligence is required first. Okay, so why does an NOL, or net operating loss, matter if it's actually based on a loss that happened in the past? Well, beyond the possibility of adding it back, why would you care about a loss carryover? Well, if the business is gone, sold, or bankrupt, etc., it's likely irrelevant, and we probably don't care. However, if it is the current business from which you're calculating qualifying income, then it is relevant, and it must be addressed to ensure that the business is stable, and we do care. Okay, so you'll want to determine a few things, such as when the loss occurred, what was the reason for the loss? For example, was it a catastrophic event or a casualty loss, or was it just bad management or a poor business plan? Because this will help you to determine the stability of the business. And additionally, you're going to want to determine the amount of the original loss to determine how catastrophic a potential recurrence might be. Now, one thing that doesn't really matter is the length of time the carryover will continue, because remember, this is not income, it is add back, so the length of continuance is irrelevant. And additionally, The further the event that caused the loss is in the rearview mirror, the better off you typically are. So the ultimate consideration when the borrower's current business has an NOL is to determine whether or not the situation that caused the loss is likely to recur. And stability is the key. So if you can determine that the nature of the event that caused the loss was extraordinary and that sufficient time for recovery has passed, you'll likely be able to determine that the business is stable. Okay, now we mentioned the possibility of adding back the NOL. So, can you add back the write-off? Well, sometimes you can, but only if it is deducted on the actual business return. So let's take a look at some examples here. Okay, this is a Schedule C on line 27A, which is where other expenses from the second page are totaled. You can see that we have expenses of $10,000. But we want to look at line 48 to see what this is. So looking at line 48 on page 2, you can see that it specifies net operating loss carryover from 2012 of $10,000. If you've successfully answered the 3 questions, when, the amount of the original loss and the reason for the loss, when, why, and how, and have determined that the business is stable, then you can add back this loss because it impacted your qualifying numbers. So let's look back at page 1. Okay, without the deduction of the NOL, the net profit would have been $110,000. Therefore, once you've determined the stability, you can add this back. So as with everything we've talked about here, you have to do your due diligence. Okay, here's another example. This time, we're looking at line 29A of 1120, which is your corporation form. And again, if you've successfully answered your 3 questions and determined business stability, it is acceptable to add this back because the amount of $8,767 reduced the cash flow we used for the corporation. Now remember that I said the NOL deduction has to be on the actual business return. So here you can see that the $20,000 in line 21 is not acceptable because it's on the personal returns, the 1040, which we all file whether we're self-employed or not, and it's not on the actual business returns. Now because you perform a schedule analysis of the actual business returns, the entry here has no impact on the borrower's qualifying income in either a positive or a negative way. But you must still, however, address the fact that there is an NOL to ensure that it does not indicate instability in the current business. So you still have a little bit of work to do there. Okay, and in this final example, you see a loss carryover on the Schedule E. Now, while this affects the taxpayer's taxable income, it does not affect your qualifying income because you're going to analyze the 1120S and the K1 for that. And once again, be sure to carefully review the business return to ensure stability of the income. Okay, this is going to be an easy one. It's our last one, and this one is so easy. True or false, stability is the key when determining to add back net operating loss. This one's kind of a freebie, I think. We may need to rework this one.
All right, and 98% of people answered true to that one.
I would expect that to be correct because the answer is true. And we've stressed it over and over, stability is the key when determining. Okay, so let's move on then. Let's talk about profit and loss statements. Now, in addition to tax returns, the lender or the investor may also ask for a profit and loss statement, or sometimes called an income statement, for the borrower's business. Now, it's typically required when the loan application is dated more than 120 days after the end of the business's tax year, or if the current tax returns have not been filed. And this profit or loss statement should cover information through the most recent quarter. So, for example, if you have an application dated May 11th of 2018, which will be coming up in a couple of months, and your most recent tax return is from 2017, even though the current tax returns have been filed, the information is more than 120 days old. So a year-to-date profit and loss statement through the first quarter or March 31st may be required. But what if you have an application date of July 17th, 2018, but your most recent tax return is from 2016 because the borrower filed an extension for the year 2017? In this case, you would likely require a P&L for 2017 and a P&L covering the first 2 quarters of 2018 in order to fill the gap. Now, the P&L can be either audited or unaudited. If the P&L is audited, which can sometimes be terribly expensive, but if the P&L is audited, you can use the information to calculate your qualifying income because it is a complete picture of verified information. And again, it's rare to get audited P&Ls because they're very costly. But if you have an audited P&L, then you will use a similar formula to calculate the income as we have been covering when looking at tax returns. However, if the P&L is not audited, which is the most common, you cannot use the information to calculate income, but you can use it to see how the business is doing. So if it's audited, you can use that information because the information's been verified. If it's unaudited, it has not been verified, but you can use it for informational purposes only. Okay, an often asked question surrounds excluding personal debts that are paid by the business. Now, when a self-employed borrower claims that a monthly obligation that appears on his or her personal credit report is being paid by the business, you must confirm that you've verified that the obligation was actually paid out of company funds and that this was considered in your cash flow analysis of the borrower's business in order to consider exclusion from the qualifying debts. So the account payment does not need to be considered as part of the borrower's individual recurring monthly debt obligations if the account in question does not have a history of delinquency, the business provides acceptable evidence that the obligation was paid out of company funds, such as 12 months of canceled company checks, and the lender's cash flow analysis of the business took payment of the obligation into consideration. Okay, let's talk about some tools that will help you with qualifying income calculation. It's a best practice to always use a worksheet when calculating self-employed income and put a copy in the file, and most of you probably do that already. The most commonly used form is called schedule analysis, which means that you'll be analyzing the specific schedule or business tax return from which the qualifying income is generated. Okay, worksheets and calculators are considered a best practice, again, because if someone else looks at the file, which they will, after you've calculated the qualifying income, they're going to know exactly how the income was calculated and not have to guess. They may not allow you to use everything you put in the worksheet, but they can follow your thought process. And again, there are several options when it comes to income tools, including the ARCHMI tax return analysis calculator, which we call the AMITRAC. But you can also use Fannie Mae Form 1084, Freddie Mac 91, or your company may have its own. Whichever form you choose, just make sure to document your income calculations. Okay, the AMITRAC, as well as the corresponding instructions, are located on our website, ARCHMI.com and ARCHMICU.com. You just simply go to the training menu and click on the first drop-down training resources, and there you'll find the AMITRAC and the AMITRAC instructions on the income section. And that's what the AMITRAC looks like, but I'm going to skip that. Okay, so we've now concluded the session, which was intended to help you to understand self-employed borrowers and different business structures, understand cash flow adjustments, which include required deductions and allowable add-backs, understand profit and loss statements, understand net operating loss, and understand personal debt paid by business. So in summary, most of the allowable add-backs and required deductions apply across the board to all business structures. So understanding the principles of cash flow adjustments and how to apply those to your income analysis is very important. So thank you for attending the webinar and allowing us to come in. Chelsea, did we have any questions?
Looks like we have just one that popped up. Karen would like to know, do you have a webinar that discussed when you can use K-1 income in regards to distributions?
We do. We do. In fact, if you go to our website, archmi.com or archmicu for creditunions.com, and click on training, and then click on webinars, and you'll see the list of webinars we have. You'll see the dates and times, and you can register for those. In fact, we have those coming up in the next couple of weeks. So we kind of break it out. This was kind of an overview, and then we break it out where we do one that does a case study on Schedule C, sole proprietorship, and then we have one that does case studies on partnership, S-Corp, and corporations. Okay, any other questions?
No other questions, and just a few thank yous. So thank you so much, Diana, for your presentation today, and we look forward to hearing from you again.
Okay, thank you, everyone. Have a great rest of your day.